Among the big winners on the day, Germany's largest lending institution, Deutsche Bank, jumping 10% after the Financial Times reported it was considering buying back several billion euros of its own debt. Those sharp gains, though, for Deutsche Bank coming after dropping, though, to 30-year lows. For more, let's cross to Geneva. And François Savary, Chief Investment Officer of Prime Partners. And got to say, earlier this week, when we heard an endorsement for Deutsche Bank from the German finance minister himself, that made people even more worried. Is Deutsche Bank out of the woods?
I wouldn't say completely. I would say that it's a good news that maybe they are going to buy back some of their bonds because it would represent a capital gain for them in the future. But nevertheless, it remains a big issue. Deutsche Bank is one of the major investment banks in Europe, and they have a significant balance sheet, and the doubts concerning the ability to master this balance sheet will be key in the future.
It's interesting because we were all completely caught off guard when the whole Volkswagen emissions scandal happened. And here there is a parallel in that this is a bank that's grown so much over the past 2 decades. Has it been caught out by its obsession to be bigger and bigger?
I don't think that it's the issue of bigger and bigger. The main issue relates to what happens with the financial system in Europe after the crisis in 2008. Lately, we had some poor development concerning the Italian banking system and concerning Deutsche Bank, which is one of the major investment banks in Europe. It proves that the work to clean the balance sheet of the banking system in Europe has been too slow, and now is facing the issue of the regulator have been increased the rule, and this is coming back in the forefront because you had some poor results from Deutsche Bank in the last quarter and in 2015 in general.
Yeah, big banks struggling to have enough cash in their vaults, you might say.
It's not so much the issue of the cash, it's also the issue of the assets that they own on the balance sheet and the quality of these assets. And the problem is that lately we had some unsettled market condition, which have brought some doubt concerning the future of the economic recovery and the future development on financial markets, which had brought back the issue what is in the balance sheet of those banks. And when you look at the numbers of Deutsche Bank that were so poor, people had doubts about the quality of the asset that they own and the fact that maybe there would be, if market conditions remain very unsettled, there would be further adjustment to the value of those assets in the future.
François Savary, for those of us who don't follow finance on a day-to-day basis, we're always bewildered when we discover these financial tools. Back when there was the crisis in 2007-8, we all discovered what a subprime mortgage was. Now everyone's talking about these so-called Coco bonds, contingent convertible bonds, basically bonds that can sort of act like stocks. Is that a good idea?
It could be a good idea. It depends on when you consider the price of a Coco. The Coco is it's a debt that has the ability to be converted into equities, forced to be converted into equities. So yes, it has the risk of an equity in certain condition, but it has more the risk of a bond in other condition. If markets are falling down, if the capital of banks, the equity capital is moving down, then there is a big problem because the probability of having to be converted from a convertible bond into equity share is increasing.
So hang on a sec. You're saying basically that a Coco bond is a good idea, but only if the markets are up.
I would say that it's, in a sense, yes, or it's for an investor in terms of risk, he needs to be aware that it seems to be a very good investment where market conditions are very clear and going up or not falling down significantly. But when you have such pressure on banking or financial stocks in general, then you have the risk of being converted from a bond to an equity that is increasing significantly. Yes, that's what I'm saying.
So in other words, this could be a product that's a little bit too sophisticated for its own good.
It depends, because it has been a cheap way for a bank to recapitalize, and it has been a cheap way for bank and financial stocks in general to get access to capital, considering the increase of regulation and the need that was imposed by the European authorities or financial authorities in general in order to support the capital of banks in the future.
François Savary, one final question for you. Just You mentioned at the outset when we talked about Deutsche Bank, some of the other big banks in Europe that also are struggling right now in what looks like an era of negative interest rates that's soon upon us. How do you get banks to lend to each other and to lend to the rest of the economy more?
I would say that first of all, we need to have more confidence in terms of what is happening for the world economy. You need to have more visibility concerning the Chinese economy. That's the first thing, because you need, in order to be able to lend, to have growth. So I think that in the past few months, you had some issue concerning the ability of the world economy to avoid a recession. I believe that those fears are excessive and that there is still a recovery underway. So I would say that the main factors is the ability of companies to foresee in the future that growth is going to be good and that they need to go to bank, and that bank provide them with lending to support their activity in the future. So the key is the macroeconomic development.
All right, so you're saying that fears of a recession are overblown. François Savary, many thanks for joining us from Geneva.